Turning hard times into good times. I'm your host, Jay Taylor, and talking to you today is the 21st day of March, 2017, and a sunny day in New York. The snow is very quickly melting, and the birds are chirping, and life is good again. So I do want to thank each of you for listening to this show and making this show one of the more popular shows on the Voice America Business Channel. I'd also like to direct you to miningstocks.com to consider subscribing to my newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. As well, you can subscribe to Chen's newsletter, chenpicks.com. You need to go to chenpicks.com, actually, to subscribe for Chen's letter. We're no longer providing that service from this office. But Chen is a good friend of mine, and I listen to what he has to say. He has some excellent ideas. He'll be on this show from time to time. And we'll be sharing some of those ideas with you as well. I'd like to also encourage you to continue sending your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com. Questionsfortaylor@gmail.com. We do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Dynacert Inc., and I'm going to be talking to the president and CEO of Dynacert in just a few minutes from now. Golden Predator, Chilean Metals, Arvista Gold Corp, Novo Resources, Uranium Energy Corp, and RN Resources. I've titled today's show, Is the U.S. T-Bond a Judas Goat? And Peter Grandich, Jim Payne, as I just mentioned, will be with us, and Michael Oliver, who coined the phrase, at least in my world, the Judas Goat, the T-Bond as a Judas Goat. Very interesting concept, and we'll be talking to Michael just very briefly about whether he still sees it that way, the T-bond market and some of the other markets. Some very interesting things going on today. Gold is showing a great deal of strength, the dollar coming under some weakness, the euro is strong, as Michael has predicted, and a lot of other very interesting things going on. So we'll be talking to Michael in just a moment. But we're going to also talk to Peter Grandich at about a half past the hour to see what he thinks about the Judas Goat idea. I know Peter has turned extremely bullish from what I'm reading in his missives recently, turned extremely bullish on gold, and certainly the gold market has moved very nicely, despite the fact, as Michael has pointed out, the dollar has been strong over the last couple of years, at least not extremely strong, but relatively strong, and in spite of that, gold has picked up a great deal of strength from its lower levels a year or so ago. So, as I say, Jim Payne will be with me after the first commercial break to talk about Dynacert. That's a company that is really, well, it looks like it's ready to explode in growth. It is providing a technology that allows large semi-trucks to reduce their fuel consumption by upwards to 20%, close to 20%, and reduce its emissions, its carbon and greenhouse gas emissions very dramatically by 40 and 65% respectively. So that's a story that we think has a great deal of promise. It's a stock that I own. It's a recommendation in my newsletter. So I'm looking forward to talking to Jim Payne right after the first commercial break. But right now, as always, I'm very excited to have Michael Oliver with me. Thanks for joining me again, Michael.
Great to be back, Jay.
Always good to be back, and I just marvel at your calls. You know, if I were a short-term trader, somebody that wanted to be in the market one day and out the next, or in and out the same day, you might not be who I look to, although I don't know who I would look to that's any better. But in terms of my investment strategy as an investor, as a longer-term holder of asset classes, I don't find anybody better, and that's why I have you on every week, at least every week it's possible for you to be on. Last week you talked about the euro as being on the brink of a major upward move vis-a-vis the dollar, and sure enough, we're seeing quite a move today in the last couple of days of the euro up, dollar down. Where are we headed from here, Michael, and are there some key areas that you're looking for as breakout points?
Well, yes. I watch the euro futures and I watch the dollar index cash. Those are the two big beasts that I think you should be focused on right now. And context. When you drive a car down a highway, you don't just look out the front windshield. That's myopic. That's like looking at one market and judging a market on its own merits. You look out the left-right mirror, you look out the rear windshield, and you get a broader context of what's going on. In the case of gold, for example, Gold has done a lot of good for itself. It registered its breakout in February of 2016. Gold miners took off at that point as well. And it did it without any help from the dollar. Dollar being weak, meaning dollar has instead been steady to firm during that time. So gold did it all on its own. But if that euro engages, which is 57% of the dollar index, if it engages to the upside in a serious way, and I think it's likely to, that's going to take the dollar index down through numbers that we think are critical. Annual momentum trend breakage. And that starts at 99 on down. Dollar is now trading in the 99s, but not as low as 99. The euro is now at 108 plus. If it gets to the very upper 108s, specifically 108.85, I think it's going to launch. And so what I'm watching is this sleepy asset category. The last year and a half, 2 years, the euro and the dollar, if you draw a line through their action, it's the dollar's been steady to firm, but you're really not. I mean, right now the dollar is lower than the high of 2015, lower than the high of 2016. So, there's really not a lot going on. The euro, same story the other way. Well, this is a huge asset category, and if it moves significantly, it'll impact all the others. In particular, I think it'll help gold, and I also think it will give more wind at the back of a commodity upturn, which I think 2017 will exhibit handily. So I think that it's very important, even if you're not in those markets, not trading the euro or the dollar, those are important pivotal markets, the left and right mirror, okay? And that's why I'm focused on it.
Yeah, indeed. I mean, that's how we measure everything. So everything is measured globally in dollars. And so if the dollar loses 5% of its value, it means that everything else is impacted by that.
Yeah, I would look for a lot more than that if it breaks that 99 level. So, and I think the first phase of that, if it does break down, and I know most analysts don't think the dollar is going down. And we've held the view that no, we think probably it is going down. And we base that on the ripeness and maturity of the annual momentum trend structure, which you don't see when you look at a price chart. You measure it by against a 3-year average or a 36-month, and you create a new vision of what the dollar index looks like relative to that mean. And when you look at that, you can see extreme age, extreme technical vulnerability to the downside. And it's been hugging its trend structure, its support too long without gaining ground, which indicates a market that's out of gas. All it's got to do is blow through this support structure. Another interesting, you mentioned T-bonds. I'm also watching the German bonds and the Japanese government bonds. So we're watching the developed economy government debt markets, and the rates are rising. They're rising a bit more rapidly in Europe because they were artificially suppressed too much. But when you look at a Bund chart, Bund futures are traded, you lay it next to a dollar index chart, they're clones, and the Bunds have broken down unequivocally. Wow. So that's another indication, I think, that the dollar is going to break down because it's, one of the influences on foreign exchange is relative rates of interest. Well, rates are rising here, but they're rising over there in Europe more rapidly because they were absurdly low levels. So it's quite possible that the rate argument, the rate rise argument, as being beneficial to the dollar, in fact, is negative for the dollar because the relative rate change over there will be more aggressive than it will be here. And it has nothing to do with central bank policy. It has to do with market forces.
Well, I think it's really interesting, Michael, because I look at things more from a fundamental point of view, and I guess when I see your technical indicators aligning with my views fundamentally, it gives me some comfort. But if we look at your, Judas goat theory, which I think is a very colorful, interesting way of looking at the T-bonds, it seems to me that the talking heads, the spinmeisters, the people that give us what we're supposed to think on television every day, from the Fed and the Treasury and everything, they're telling us, look, the economy is getting really quite good, and look, of course the interest rates are rising because there's a strong economy out there, and I suppose there's a lot of people have been buying into that, buying the stock market. Yeah, stocks are overpriced, but by golly, we got an extremely strong economy, and it's getting better, and the Keynesians are finally having their success. That is what you meant by the Judas goat, I guess, the T-bonds, rising interest rates. Right.
This actually happened in 1987. The T-bonds suffered a huge decline in price, rise in yields, and the S&P ignored it. The first half of the collapse in T-bonds for like 6 months or so, the T-bonds went down like 20 points, T-bond futures, and the S&P said, going up anyway, and peaked in August. And finally in August, it started to acknowledge the T-bond breakage, and it started to roll over, first off gently, much like we're doing now. You know, we're all of 50, 60 points off the recent high. It's not a big collapse, it's a couple percent.
Sure.
It could be the start of something. And at 87, sure enough, the T-bonds, they didn't quit on the downside until they knocked that stock market for a loop. It wasn't until the crash day the T-bonds said, okay, we're going to rally.
Yeah.
And because there's always that risk if you're short T-bonds based on an expectation of higher rates. If there's ever a sharp stock market sell-off, it could hurt you. So be careful in that regard.
Right.
But net on balance, I think T-bonds interest rate rise in the developed economies is a Judas goat leading the stock markets down.
Yeah, well, we're seeing a pretty strong day today in the bond market. I guess that what you're talking about is money coming out of stocks going into bonds. And as long as people believe in the system, as long as they believe that there's nothing catastrophic going on, then I guess that back and forth action can continue, right? It's when there's a loss of confidence.
The bonds are going lower and rates are going higher, but you can have these brief interludes, what I would call a counter-trend rally in the T-bonds. I don't think that people buying bonds now because they're afraid of stocks today, for example, is a sustainable thing. I think T-bonds are actually in a major downtrend, meaning rising yields. And stocks are just now acknowledging maybe that fact. And they'll join hands. In the bigger picture, they'll be together. Bonds will decline in price, stocks will decline in price.
Yeah.
And I think that will match up. But in the short run, when you get those emotional moments, you can get that counter-trend bond rally like we're getting today, I think. Yeah.
Right, just money coming out instinctively, just coming out, some safe place to hide it for now.
Fear. Yeah.
But if there is a sense that the bond market is really going down and interest rates are going to spike up well beyond anything we've seen, there will be a panic out of the bond market and out of the equity markets until such a time, I would imagine, as things settle down and people start looking around and say, "Wow, those yields are tremendous." You know, and you know, maybe they want to stay in bonds, or the stock market has tanked so badly that relative to bonds it starts to look good. But boy, you can't make that case now, I don't think.
No, I don't think you can.
You can't make the case for either because they're both overpriced. I think, without a doubt. At least I look at it from a fundamental point of view, and then you look at it from your technical point of view. With just a minute left here, Michael, let me ask you the gold. And you put out a missive on gold today. What are you looking for gold? What are some key areas that we need to get through to see a higher price?
Well, the high about a month ago was 1264, and then we dropped down under 1200. Okay, now we're up in the mid 1240s, and I think if you touch 1253 and change, gold's going to take out that last high. In other words, about $11 short of that high. Momentum says you're going to take it out, and therefore at that point, all the people who got bagged again in another gold correction, thinking, "Oh my gosh, it's all over," will be faced with a situation where gold takes out a recent relative high, the 1264 level, and again shows them, it was just another correction. I understand it's tough for a lot of people who are long gold, especially if they're leveraged, to weather these things. But in the big picture, it's still positive. And these sell-offs, as nasty as some of them can be, they're all counter-trend moves to the downside. They're not part of the major uptrend, which I think is underway, and which I think will pick up steam, especially if the dollar breaks 99.
All right, very good. Well, it's this sort of longer-term vision that I have that you're very helpful for, Michael. I want to thank you again
thank you, Jay.
For all that you've done for me and for our listeners, and we'll look forward to talking to you again next week, hopefully.
Talk to you then. Bye-bye.